All right, in my class, we've already looked over the stock market and some various other things. This will be a quick presentation on some other investment options you have out there. And basically, the goal is learning how to invest and save for a secure future as per the state of Texas. Always remember the time value of money. A certain amount of money saved today is going to be worth more than the same amount saved in the future. I even had to pause for a second and reread that because that's a big huh. But time is money. And basically, the longer you invest, the more money you can make, especially if you're compounding. There's two different kinds of interest that we deal with, simple interest and compound interest. And you want investments that compound interest over simple interest. It's very straightforward. You'll want to pause this video and go to your PowerPoint and launch this video on Investing Basics, the Power of Compounding from Invest Tools. Go ahead and pause it, go watch that, or go back to it later, but you need to watch it. It talks about the power on compounding and how you're stacking the money you make on top of what you had so that you have more to calculate interest on. And there is a formula. I will not make you use or learn this formula in my class because we simply don't have the time. Whoops, went too far. Basically, it's a very straightforward formula. Most of you can probably do this. M is the final amount that you're going to end up with. P is principal, I is interest rate, N is the number of years. And you do this investment down here, and you can see that after a period of time, you're going to make a profit on it because it's 5% compounding interest. You should understand that from watching the previous video. Rule of 72 is always going to be important. The rule of 72 is an easy way to see how many years it'll take to double the money made in an investment. Basically, you take your interest rate of your investment and divide it by 72, and the number you come up with will tell you how long it's going to take to double that investment, how to turn your 1,000 into 2,000, your 5,000 into 10,000. And obviously that's something you're going to want to look at and think about because time is money. The quicker you get started, the better off you will be. I'm a realist. I'm not really expecting you to do it right now, but as soon as you settle down in life and everything, you need to start investing. And the rule of 72 will tell you how long it'll take for you to double your money. And basically there's the little formula right there. And as I keep saying, time is money. Investment is the act of redirecting resources from being consumed today so they create benefits in the future. It's the use of assets to earn income and profit. And it's only going to really work in a free enterprise system like we have in the United States. The socialist democracies of Europe and stuff will have this too. But you need a free enterprise system. It's not going to work in North Korea as long as little Kim is there running the show. The Chinese have learned this lesson too. They let people own businesses now. They let people invest. They let people do things they didn't do in the past. The problem is you have a business partner at all times. If you have a business in China, it's the Chinese government. You have no choice. Savings and investing. Investing promotes economic growth and stability. Investors can profit, and combined with savings, they can provide for a secure future. You're always going to have people looking to borrow, and you're always going to have people saving. We do have a problem in the United States. We have very low savings rates right now. We have more people looking to borrow than to save. Some of that is the discouraging stuff. At the time I'm recording this, we have quote-unquote record low interest rates, which means you can get really good deals, which also means that the savings accounts that you have very low interest and they don't make you a lot of money. And so people are living paycheck to paycheck. There's a lot more borrowing going on. Some people see there's no use in saving, which is a bad way to go. But you want borrowers and savers, and you kind of need a balance between that. And we'll get into that kind of stuff later on in other units and in this unit. You always need intermediaries to help link this up. Now, in today's world, you can get on computers, but those computers belong to, those programs you can log on to, or those sites you can log on to, rather, are going to belong to these intermediaries. You might have seen like those E-Trade sites with the baby and all that kind of stuff. But financial intermediaries are the ones that are the institutions that are going to help channel funds from savers to borrowers, and there's going to be a lot of overlap between them in today's world in the era of deregulation. One of them is a bank. A bank helps keep your money safe, and we're going to get into banking a lot later in later units. And they also allow you, via the interest rates on your savings account, to make money. Because you got to remember, your money's just not sitting in a bank doing nothing. They're actually risking your money to make a profit and share that profit with you by giving you a return. They take all the people's money that they put in there your $5,000, somebody else's money or whatever, and they give somebody a loan for a car. They pay back that loan plus interest. That's a profit to the bank, and then they give you a cut of the action because they were using this. And they've got to manage their risk like you do also, or they can get in trouble. But they do all this through loans. And it's an arrangement where the lender gives money or property to a borrower, and the borrower agrees to return the property or repay the money, usually along with interest at some future point. They don't really want to return that. It's kind of usually repossession and stuff. But usually there's a predetermined time for repaying the loan. Generally, the lender has to bear the risk that the borrower may not repay the loan. So there is risk in there, and that's why they'll come after you with collection agencies and stuff if they are not getting their money. The interest is the fee charged by a lender to the borrower for the use of the money. It's usually an annual percentage of the principal. The principal is the amount you borrow. Interest is everything you pay above that. And that's the return on an investment. Financial intermediaries continued, tongue-tied, principal. That's always the amount you borrowed. I was kind of touching on that here a second ago because it's in here. Principal is the amount you borrow. Interest is everything you pay above that. The principal is the amount borrowed. The part, basically, I'm just rambling at this point, so I'm not going to bore you with it anymore, but I think you'll get it. Read over it if you don't get it. Financial intermediaries continue the things banks do for you. They do also store your money and keep it safe. The FDIC, Federal Deposit Insurance Corporation, protects that money. That used to be a problem in the old days. If a bank ran out of money or was destroyed or robbed, you'd lose everything because of the fear that was associated with banks and losing your life savings. If anyone thought there was something wrong with a bank, they do these things called bank runs that we'll touch on in this term. And the FDIC is trying to prevent that. They're guaranteeing your money. In 1933, the FDIC was created in response to the Great Depression to ensure and back customer deposits if a bank fails. If anything happens to the bank and it cannot cover your losses up to $250,000 today, we're not going to worry about what they started at, but it's $250,000 today. It's been up to that much current as you're listening to this. The insurance will kick in. We'll return to this subject later on when we do more with the Federal Reserve System. They help you save money, and you put your money in there and you get an interest rate on your savings account. They do checking and debit cards. Debit cards have really taken the place of checking. Nobody really messes with checkbooks anymore. But a debit card, always remember, a debit card is letting you access, and so is a check, letting you access the money you have in storage. And you can use the debit card to buy things immediately. You can use a check to buy things immediately. You can use the cash in your pocket to buy things immediately. What's going to happen is if you have money tied up in an investment like a piece of art, you've got to sell that art in order to be able to use it. So that's not going to be as liquid as an asset. We'll get into that kind of stuff as we continue this term. Loans are provided to consumers and businesses for a fee, and this is one of the big areas that banks make a lot of money. And they can be car loans. I'm sure most of you know what that is. And then a mortgage, you need to be what that is. Know what that is. That's a loan for property. A house, it can be commercial, it can be for investment property, that kind of stuff also. And then keep in mind a credit card. A lot of people get confused. They think credit cards and debit cards are the same thing. Debit cards let you access the money you already have that's stored in the bank. Credit cards, you're borrowing money that you don't have and promising to pay that money back plus interest over a period of time. So the better your credit, the better interest rate you'll get on one of these cards. You got to be really careful with this stuff, though. This is some of the stuff that's really killing Americans today, the credit card debt, things that we're going to touch on in class and continue to talk about throughout the term. There are other things out there like the S&Ls, savings and loans, finance companies, and all that kind of stuff. Deregulation, the differences between banks and these institutions have disappeared. There used to be specific things that made them different, but now they all kind of function the same with deregulation. And so, basically as a result of something called the savings and loan crisis of the 1980s, they had to start regulating these guys and watching them because they had all this history we're going to learn about of watching banks and managing them and having laws and overwatch over banks and stuff. And when they deregulated a lot of these other intermediaries like S&Ls, they were making the same mistakes banks made at one time. And the S&L crisis in the 1980s is a big deal. But these guys used to be very different. There used to be distinct differences between some of these things, and now you can't really tell them apart from a bank. An S&L, for example, originally pulled deposits of members into large funds where they could draw interest to pull money to buy homes. You got a little bit of better interest rate and some breaks and stuff if you were promising to put this money into this account to buy a home only. And if you pulled it out for any other reason, you got penalties. But the deregulation thing was like, oh, little Timmy needs braces, and mom and dad got all this money tied up in an S&L, and they should be able to access it. And the second that they started letting people access this money, you're saving this money supposedly for the purchase of a home. You used to not be able to pull it out until you bought a home, but now they're letting you take small amounts out of it. You basically have turned into a bank, and the deregulation, they started to function more like a bank. There was fraud and all sorts of stuff and risky loans and things like that, so they ended up having a crisis, and they had to have an act to cover this and everything and to watch these guys. But basically they look, taste, smell like banks now, but they used to have that. The distinct difference with the S&L was you were pulling your money out only for a home. You were getting a better return because of this and some breaks, and you couldn't access that money for anything else. They started letting people have access to that money and draw from it, basically turning them into a bank. There's the credit unions, which used to be for particular groups. You had to be like a teacher that belonged to the teachers' credit union. They usually could bargain and get better rates for their people and stuff, but now pretty much anybody can join a credit union, whether they want to, if they want to or not. Finance companies are really interesting because finance companies, it used to be those were where you got your worst deals. A bank wouldn't give you a loan, and so you went to a finance company and they'd take the chance of giving you a loan, but they charged you a lot more interest. But now we've got these finance companies that belong to things like Ford that offer 0% interest. Because think about this. Would you ever loan anybody $30,000 and not charge them interest? You might if it's a close family member or something, but it really makes no business sense. But we have these 0% car loans. And what it is it's Ford has a finance company, Ford Motor Credit, for example. And Ford's hoping to steal sales away from other car makers by offering 0%. You come in there, buy a car from them, and they're giving you this great deal, and you're getting 0% interest on the car, just pay, some fees that you pay and everything. But this is also probably one of the reasons why some of the car companies got in trouble. They backed themselves into a corner because people bargained down the price of cars, and the profit margins were really, really low at this point because you're not getting any interest off of loans. But a bank wouldn't give you 0% for a brand new Ford, but Ford Motor Credit will because they're tied into Ford. It all goes, and they're just trying to steal sales, and it's going all back to the mothership and everything. But you have that deal where you can get some of your best deals if you have good solid credit. You can get things like the 0% on cars, but some of these guys still specialize in high risk lending, and they lend money to people that really probably shouldn't be able to borrow in some cases, or people who have had bankruptcies and stuff. Mutual funds, we're going to pick this up in the next video so that I can break this up. This video is already about 14 minutes, and so I'm going to go ahead and cut this off, and I'll come back in a part 2.